Hey everybody, this is Chapter 10, Problem 3. And what's difficult about this is that it isn't just like one process, like production and purchases and production, for example, but it has everything all mixed in together here. So I'm going to actually go over the solution here with you and see if this helps. And if you've got any other questions after that, let me know. But we've got, this is what, tourist trinkets? Yeah. They've started out with a $70,000 cash balance, and then they give you a lot of information here, but half the sales are on credit. Of those on credit, 75% are collected in the same month, 25% the next month. Sorry. Sales for June were $125,000, and expected sales are $160,000 for July and $130,000 for August. What else? Desired ending inventory is 15% of the next month's sales. We know what that means. And the gross margin percentage is 60%. I'm sorry, is 40%. So what I was thinking, if gross margin is 40%, that means the cost of goods sold is 60%. Okay, it's an important thing to understand. And payments to suppliers are made at 70% in the same month as purchases are made, and 30% the following month. So when they buy something on credit, which would be all of your suppliers, it's 70% in the month that they purchase it, and 30% in the next month. That's how they pay it. Total monthly fixed selling and administrative costs are $25,000. And of this amount, $10,000 is depreciation. So what they're saying here, if that $25,000 includes $10,000, then $15,000 are variable, okay, or in cash, whereas depreciation expense is a non-cash item. Okay, so that's you want to make a note of that someplace. All cash expenses are paid in the month incurred, obviously. Variable selling and administrative costs are $2 per unit and paid in the month incurred. The selling price is $16 per unit, and the company plans to buy a small parcel of land at the end of July for $15,000. Okay, that would be a capital expenditure. Okay, so let's go through the questions here. The first question is, what were the purchases in June, and what are the expected purchases in July? So we've got a beginning balance of $70,000 in cash. Didn't they say they had 75,000 sales in June? We're wondering. Hold on one second. Okay, so what we have here are two T accounts of finished goods inventory for June and for July. And I'll tell you right now, this is not easy, okay? We have cost of goods. Our sales for June were $125,000. Okay, so if you take and we know that our gross margin is 40%, so the cost percentage is 60%. Okay, so if we take 125,000 times 0.6, that gives us 75,000. Okay, which is what our cost of goods sold would have been. So that is cost. So that cost is coming out of finished goods inventory. Okay, and that would have been or our beginning balance would have been 15% of that 75,000. Because desired ending inventory is 40% of the next month's sales. Okay, so if that's our next month's cost of goods sold, that 15% would have been, 15% would have been the beginning balance in the finished goods inventory. Okay, was the desired ending balance from the prior month. Okay, and then finished goods for July. What do we have? We got 160,000 in sales times 0.6 gives us, oh wait a minute, 160 times 0.6 gives us 96,000. Yeah, 96,000, and 96,000 times 0.15 gives us 14,400. Okay, so that would have been our beginning balance. This is what would have gone out the door. So we must have bought 93,300. Okay, 93,300. Like if you made that a T account and your balance, you're trying to figure out what your balance is right here. Same thing for that first finished goods inventory. Okay, so what do we have here now? Oh yeah, 14,400 is the, yeah. Okay, so let's go down to here we got cost of current sales, okay, plus ending inventory gives us how many we need, minus beginning inventory is how much we had to purchase. So our cost of current sales was $75,000, and that's 125 times 0.6. I keep doing this. 125 times 0.6. Yeah, 75,000. Our ending inventory would have been, in the month of June, was 14.4. Okay, 14.4 from here. That gives us 89,900 that we need. Beginning inventory was 11,250, and purchases then would have been 78,150. And we go through the same process here for July. Oh, okay. So the next question, what was budgeted cost of goods sold for July? Would have been 60% of the 160,000 in sales, or 96,000. Okay, that would be reported as an expense on the July income statement. Okay, now budgeted income before taxes for July. We've got sales in July of 160,000. Okay, we just divided it by the selling price here to get 10,000 units. We know how many units were there. And cost of goods sold was 96,000. Right? Oh, this is July. Yeah, 96,000 in July. Gives us a gross margin of 64,000. Selling and administrative expenses, the variable ones were 10,000 units that we sold times $2 a piece. It's 20,000, and the fixed is 25,000. We've got that in here someplace. Here, right there. There's the 25,000. So that gives us operating income of 19,000. So that operating income here, that is income before taxes. And on a financial statement, the tax line comes out right after operating income. I mean, you might have a couple other squirrely things in there, okay? But taxes will be toward the bottom, and then we've got income after tax, okay? Next question is, what are the budgeted cash collections in July? We've got cash sales of 160,000, so 50% of that is 80,000. And then we collected cash sales, collection of cash sales in the same month, 75%. So we would have collected, oh yeah, those are cash sales, 50%. The other 50%, we're going to take that, we can get 75% of those. So 75% of 80,000 is 60,000 came in. And then from the prior month, in June, we would take our credit sales from June of 62.5 and multiply that times 25%. And that would be our total cash receipts from operations. Okay? This is really a tough problem. I can only apologize. I didn't have time. I've never used the book before, and I didn't have time to do all these problems before I did the syllabus. So such is life, huh? What are the budgeted payments to suppliers? We paid 70% of purchases in the same month. So in July, we were purchasing 93.3. Where's our purchases? It's up at the top. We calculated our purchases up above here. So here in this little schedule. So in July, our net purchases were 93,300. Okay, so that would be, I lost it, here we are. 93.3 times 0.7 gives us 65,310. That's how much we would have paid. Payments for purchases from the prior month would be the remaining 30%, so 78,150 times 30%. And July payment to suppliers would be 88,755. Okay, and this is a financial master budget they've got. And what we've done, we talked about this a little bit in cash today, or in class today. We had, okay, these are cash inflows and cash outflows. So this is what came in. We've got a beginning balance of 70,000 that they gave to us way in the beginning. Yeah, 70,000 cash balance. And then we've got cash sales of 80,000. Collection of July credit sales of 60,000. Collection of June credit sales was 15,625. So these are our total cash inflows. Okay, this is just for cash now. And then we paid for July purchases, June purchases, and then the cash operating expenses then were 35,000. Okay, So this is total cash operating outflows, 123,755. So, and then we've also, so these are operating cash inflows, operating cash outflows. On an investing perspective, we decided that they told us they were going to buy a small parcel of land for $15,000. So that would be sort of on the credit side. $15,000 is planned, and we've got $225,625 available, minus $138,755 is what we need. So our ending balance is $86,870. Okay, getting there. What's the budgeted balance of accounts receivable on July 31st? Accounts receivable, let's see, balance would be July credit sales not collected. Okay, that would make sense, 25%. So 180,000 times 25%, or 80,000, I'm sorry, times 25% gives us 20,000. And finally, what's the budgeted balance of accounts payable on July 31? That would be your July 31 balance. So of July credit purchases not paid, so 0.3 times 93.3, or 27,990. Okay, now this wouldn't have been so bad if this had been more clear at the top. Okay, this is a piece of work right here. I don't know, I probably should have talked more about what this T account would look like, say, for finished goods. But you've got a beginning balance, plus purchases, minus what went out into, what was sold. Okay, that's what's in there. Okay, I hope this helps. Alrighty.